In this week's update, rotation is on in earnest, and the US market response to AI-related earnings. My name's Gary Davis. I'm an authorised representative of Primary Securities, and this is general information only in this video. It's going to be much shorter this morning for a couple of specific reasons. We have just started what we've been talking about as the most pivotal earnings season in the US in 40 years. And we're only a couple of days into the serious stuff, but already it's throwing up lots of changes. The spotlight, of course, is on the hyperscalers because it started with Google, but next week is also a big week with another 3 or 4 of the majors reporting. So we'll have a lot more information. I suspect it may not deviate a lot from what we saw from Google, and that is giving the market some concern because it's all about, can the enormous sums of money being spent on building more and more data center capacity, can that be justified? Will it actually eventually produce an acceptable financial return? And who will capture the benefit of that? Because there certainly will be beneficiaries, but they may not be the ones that we expect from natural conclusions. So there's a lot of really vital information, not only for the rest of this year, but probably going through for the next several years as well, because the market needs to see the economic return for these staggering sums of money, which frankly would be making a contribution to the US economy in no small measure. If you removed all of that spending, I just wonder how the US economy would be tracking. So the market response is the most vital part. It's really the only part. We can have a fantastic fundamental story or a terrible fundamental story, but it's what prices are doing that really matters. And we've still got the remains of some forced selling that came from leverage in a number of different areas. And so we're still getting significant volatility on a day-to-day basis, up one day, down the next. So that makes it very difficult, certainly for traders. If you're a long-term investor and you really sort it out and you know what your plan is, you know what your timeframes are, then this volatility, you can just ignore it. But for everybody else, it's something that we need to factor in. We're going to need a few more sessions. We've had 2 US sessions post the Google results. We're going to need a few more yet because the market's still sorting out what it thinks about it all. But at the moment, you would have to say that the market conclusion is more negative than positive. However, the question is, how negative will it get and for how long? That's the key question, and that's why we need to see some more sessions. So this weekend, there's an awful lot to unpack, and we've been devoting our attention to members who are always our priority. And anyone listening to this is very welcome to come and join us because members are getting extremely well informed about what's going on, where the probabilities lie, and what conclusions that we can draw. This period has already started with some rotation, some new leadership, some potential reversals, but nothing that I would really get excited about at this point in time. But they're coming because it's that kind of market, and when I walk through the charts, you'll understand why. Now, I thought I'd just show one chart, which is the forward free cash flow. So that's the next 12 months, and it's free cash flow for the hyperscalers. And you can see way over here on the right that everybody's free cash flow is plummeting, and that as an aggregate, it's almost nil. So almost all of the free cash flow of the hyperscalers is being put back into data centers. So there's a couple of ways that you can look at that. And this is the big consideration point for the market, is this disappearing free cash flow, because these companies have been throwing off just staggering sums of free cash flow for years and decades in some cases. If you're a bearish observer of the market, investor in the market, then you could look at that chart and say, well, the trend of free cash flow is horrific. Look, it's just plummeting. It's almost disappeared. And then add on top of that, can the expansion actually be supported by the absolute essentials, which is can they get enough power and can they cool the damn things? So that still may be an issue. So that would be the bearish interpretation of that. But of course, we can have a bullish interpretation of it and say that, well, the hyperscalers are so confident in the demand and so confident that they will get eventually a commercial acceptable return that they're prepared to reinvest every cent of free cash flow back into the expansion of infrastructure because they've got the proof of demand. And there's nothing wrong with that argument. It's just, it looks very unstable to me, and I can't get to the bottom of what else might be going on within those companies with respect to their financial metrics. It just looks and feels to me like the rubber band is being stretched a bit too far, and that makes me nervous. Now, that's not a negative outlook on the long term because I'm as bullish on AI and what it's going to do in terms of changing the world and the way that we live our lives, but what's going to happen in the interim? Has it gone too far too fast and the market is now going to correct that excess? Certainly the probabilities of that happening are building. I think that's a fact. It's not necessarily going to fall apart, but the probabilities are not as attractive as they were 6 or 12 months ago. So the hyperscalers, from my perspective, seem to be a bit between a rock and a hard place. The probability of a positive outcome, even in the short term, is lower. And again, let me highlight the word probability. That's all that I work with. I don't form an opinion, a firm opinion that I can't backtrack on because it's just stupid and pointless. But the probability of a positive outcome is less than it was some time ago. And at the same time, hyperscalers are doing more of what is annoying the market, and that is continuing to ramp their capex. And the market is not comfortable that they're seeing a pathway to the sort of economic returns that would be justified. I think that's a pretty fair statement of where we sit. And that really has to guide when you buy, what you buy, and what price you pay. And is it a case of they're caught between competition and commercial reality? Because the durable economic return hasn't been proven. I've been talking about this for weeks, but they're in competition with everybody else. And can they afford to back off in terms of capex? What will that do to their position in the food chain and their ability to negotiate contracts? All those sort of things. So are they caught where maybe they don't want to invest so much of their free cash flow, but they're just forced to? I don't know the answers to that, but I know that it's causing me to consider my priorities and my weightings, at least recheck them. Now, this environment was still so many uncertainties because I don't think the Google result on Wednesday night, Thursday morning for Australian investors is as attractive to be involved in the short term. Let's just let it play out, and then we've got the odds more in our favour. I think that's the main point of this. As is getting all your own information lined up, all of your advice, etc., and particularly your investing plan. If you don't know what it is you're trying to achieve, then it's going to be extremely difficult in this market to make a success of it. So let's go and look at some charts. We'll start with the NASDAQ, and you can see that technically it's a minor break. So we pick up these highs and lows through here, but candle ranges are pretty short. Okay, we had a big gap here into Thursday, which was a lot about the Google earnings, which were announced after the market closed on Wednesday. So we had a big gap down. So I guess you could have envisaged that as a big red candle. But then Friday, there wasn't really much in the way of follow through. So I'm not sure that I really call that a break of support at this point in time. But you've got to say, as I've been highlighting for a couple of months now, we've got a change in character. There's absolutely no question that that is different to that. And we've got lower peaks, succession of lower peaks. And now the hint of a lower low. So you can't ignore that overall at the index level. This is a ratio that I've looked at for years and years and years, and it was a great indicator for what unfolded in 2022 when technology went down for nearly 12 months. And it's consumer discretionary versus consumer staples. So money is moving from the more aggressive sectors of the market to the more defensive parts of the market. And it is what it is. The US market is moving into a more defensive mindset. So that tells me that big, high growth stocks are not likely to outperform. They might do similarly, but they're not going to outperform. This is SMH, which I showed last week in a couple of parts, but I just want to highlight on the last little bit because this is absolutely critical. And you can see, again, we've got fairly steeply lower highs and lower lows. So there's a definite channel heading in the downwards direction. And there was significant volume around that on Friday night as well. Let's look at the sector level. We've got new leadership now, healthcare, finance, industrials, and then energy. But what's more important is the rate of change. This is XLK. Now it's sitting second on the totem pole at the moment, but look where it's come from. It's falling very steeply relative to other sectors, whereas healthcare is going up, finance is going up, industrials, which is a real mixed bag, but it's going up quite nicely. But we've got consumer discretionary really falling away on a relative basis, and communication services as well. And energy is also very steeply, this is the red line, energy is steeply rising. So that's a pretty graphic example of this rotation in leadership in the American market. Our market, I look at that chart and it's very hard to deduce a whole lot from that. To be honest, so I'll just move on because so many sectors in the Australian market are just dominated by a couple of companies. It's really not that representative to do that comparison in Australia. This is also another interesting chart that was a big signal for me at the start of 2022, and that's the NASDAQ versus the S&P. And quite clearly, the money had been going into growth stocks since the lows January 2023, but that has certainly started in a reversal type of pattern. There's the S&P holding up much better than the NASDAQ, and there is the Russell also. That's on a weekly chart, the Russell, so that's also doing quite well. And there's no enthusiastic selling in the small part of the market. If this was a significant market top where money was leaving the market net, then the Russell wouldn't look like that. So the US market is still positive in the sense that money is not leaving, money is rotating. And those rotations, as we saw in 2022, those rotations can last 12 months and they can go down a long way. So you don't want to assume that you can ride it out. You actually want to think it through. Let's move to precious metals. First of all, silver. Now, the first thing that I notice on this chart is that we're now getting a basing pattern. Now, that can always break to the downside. This could just be a sideways pause. But it could also be the end of the downward momentum for gold and silver. I think the odds of that are rising. However, I'd also point out, in a minute I'll get to the chart, those things can go on for a significant period of time. This is the gold chart, and again we're seeing the same sort of thing with less volatility. But the question is when, and I'll show you some very stark charts. This is the gold price versus the S&P, and again maybe we're starting to see the downward pressure, the outperformance of stocks over gold. Maybe we're starting to see that downward momentum start to stabilise, and of course that's the first thing you've got to do before you can reverse back up again. And there's the Australian dollar gold price, which managed a bit of a jump up during the week. But if we go to the miners, and I'll go back to here. So this is GDX listed in America. And we know all the problems. This is a monthly chart, by the way, because I wanted to capture a really big picture of gold. This index tracks the NYSE Gold Miners Index in US dollars. And you can see right over on this side is 2006. So we're capturing a lot of ups and downs in the gold cycle. And we know that we can point to all these factors that are happening in America and around the world and with interest rates that should be absolutely amazing for gold. And it was for a while, but now we've pulled back. But when you step back and look at the big picture, this was a period of excess and hype. It just got really, really hot for 6 months there in the gold market. So is most of this decline just about the natural dynamic of the market? 3 steps forward, 2 steps back. And often if you're only looking at a daily chart and you're only looking at the last month, then you can get a completely different picture about what is building. So on a monthly chart, I see this pullback, rather than being some sort of death knell for the gold market that is being presented in many areas, I just see this as part of the normal 3 steps forward, 1 or 2 steps back. It's just repositioning. And when you couple that with the loss of downward momentum or the reduction in downward momentum, then it kind of puts a bit of a different light on it. So just summarising all that, gold added 1% for the week, 5,900 in Aussie dollars. Silver added a bit more, of course, as it does, back up to 58. But we're definitely losing the downward momentum, that's for sure. It was a nothing kind of week when you look at it, but when you step back and look at the bigger picture, then it was actually just another tick in the box of, are we now in a basing pattern for gold? So wrapping it all up, the final message, the market response to the Google earnings were that it's confirmed what was already unfolding, and that is that AI in tech is going into a downtrend. But the question is, how long, how far, and certainly which stocks? Because if you look at the market response in all the key 30 or 40 or 50 US AI stocks that we watch very closely, the divergence between how the market responded to those ones was quite substantial. A buy the dip opportunity is coming, but I have no confidence that buy the dip is coming in the very short term, i.e. the next week. It might, but I think that's a very low probability when you put everything together. So I think the most important thing at the moment is if you've been in a mental pattern of course, everybody else is doing this, so that's what I will do, and just flowing along with the prevailing belief that AI is completely unassailable. Of course, it's going to be good. If I buy any dip, I'm going to be fine. I think that's a low probability at this point in time. I might have a different view next week if the other hyperscalers report and the market response is wildly positive, but I can't see it looking at the drivers. So again, don't get me wrong, I'm not turning negative on AI at all. It's the time frame. That is the issue. And we've got leadership rotation, which means opportunities, lower risk, higher reward opportunities in stocks that have been ignored. So why would you continue to try and squeeze the last bit out of the AI orange for this cycle when there are far better reward for risk alternatives? So we're certainly looking more widely. What is strong, what has really strong fundamentals and is in a basing pattern. So when you think about that setup, that means that by definition, if we're in a basing pattern, that we've got relatively less downside and we've got much more upside. It's all pretty basic stuff. So my observation overall is that investors, if you just want index plus type returns, then do some thematic ETFs. But if you want something more like really good returns from the market, then you've just got to become more stock specific. And we've got an absolute mountain of them on our watch list. So that's it for this week. There's more information on the website. There's my email address, and I think it'll be a fascinating week next week once we see those hyperscaler results coming through. So I'll be back with you then. Cheers.